Greetings, everyone. We're so happy that you could join us for another one of our live webinars. I'd say we live in interesting times, but honestly, it's always interesting times. I know with Lauren and Yusuf and I have many times with some of you looked at the graph of returns to your portfolio over the last 10, 15, 20, 25 years, and we can point to every little wiggle and say, oh, there was the Greek debt crisis, there was the fiscal cliff, there was the so forth. And you know what? The interesting times continue. So we hope to be able to connect a few dots for you today and tell a story about some of the major world events and how they're connected and how they're affecting you. And with that, I'm going to actually turn it over to Yusuf.
Thank you, Dave. And Lauren, if we could go ahead and launch our first poll. We want to start our conversation with you today by taking your temperature, asking you how you're feeling. So the poll should be up and live, and feel free to respond as soon as you can. But how are you feeling about the current economic environment? We'd love to know. We've given you some options: panicked, a bit nervous, neutral, optimistic. And if you're feeling some way that's not quite captured by any of those words, feel free to submit your own sentiment, your own word choice via the chat function. We'll keep this poll going for another 30 seconds or so while people are getting settled. And it's looking like the vast majority of you are avoiding panic. Good. Maybe feeling a bit nervous. Hopefully we'll be able to quell some of those anxieties today. All right, go ahead and close the poll. For those of you who responded, thank you. And if you have a chance to share more via chat, by all means, go for it.
And Yusuf, I'm just sharing the results so people can see. We've got about 72% on a bit nervous. We've got someone between panicked and a bit nervous in the chat, and then someone borderline wanting my mommy.
All right. Fair enough. So let's move on and share what those dots were that Dave was referring to. We're going to, as Dave said, try to tell a bit of a story that weaves these talking points together. We'll be giving our take on the economy's health. We're going to talk about inflation. I'm pretty sure we'd get the hook if we didn't mention inflation at all during this webinar, given recent news. We're going to talk about the war in Ukraine and the ramifications worldwide, the Fed and the role it's going to play in this story, and we'll close with a discussion on how financial markets have been performing and how our clients' portfolios have been doing in the midst of all of the news and uncertainty of the beginning of the year. To help guide our presentation, we're going to launch another poll here and ask, which of these 5 topics are you most interested in? And we'll try to tailor and calibrate our comments today around what you all are looking to hear most about. Right, fairly even distribution so far.
And I just have to comment while we wait that there are obviously economic ramifications for the Russian invasion of Ukraine, and we're going to talk about those. And they do have ripple effects that are affecting lots of different parts of the world. But I just have to say that the bravery of the Ukrainian people has been truly inspirational.
Hear, hear. Well said, Dave. All right, we've given it about a minute, and thank you all for responding. It seems like we're going to be able to spend a fair amount of time on each of the segments here and satisfy what you all are looking for. But by all means, should you have questions, submit them through the presentation, and we'll look to make sure that we speak to everything that our attendees are looking to hear about today. And with that, we'll dive in. We've said it before, we'll say it again. The recession that we've been dealing with and recovering from was first and foremost caused by a medical shock, obviously COVID being the culprit. And we've said that improvements in that area would be the driver in the recovery, and that has been the case. With the wider and wider availability of vaccines and treatments of COVID. We've seen things improve in markets and the economy over the past couple of years. This is a busy slide, and we admit that and appreciate that. What we wanted to highlight was the shape of the curves, which are illustrating admissions, hospitalizations of folks with confirmed COVID cases over the past year and a half. You can see the waves up and down, the surges. Here's Delta, here's Omicron here on the right, and you can see the same curves broken out by age demographic. The things that we wanted to highlight, obviously, are the points that we've circled. The current 7-day average of hospitalizations, about 1,400 folks nationwide. And why we think that number is important, when you put it into context, that number is down 93% since the peak of Omicron. And surely you've been hearing that case numbers are ticking upward, and yet we're seeing that the relationship between case numbers and hospitalizations is turning negative. There's a negative correlation, meaning that case numbers are going up and we're still actually seeing the hospitalization numbers come down. That's extremely encouraging. And so as we've entered the phase where we're now shifting from it being in a pandemic to having COVID just be an endemic part of our society going forward, we find these numbers to be incredibly encouraging, and wanted to make sure that we highlighted them at the top of this presentation. Now, this is a chart that you've seen, and this has been a chart that we've used to take the temperature or check in on the health of the economy throughout the pandemic. Just a refresher, in purple, you're seeing claims for unemployment insurance. Of course, when the economy shut down, those claims shot up to more than 6 million per week and have since been moving downward. In orange, the unemployment rate, and then in blue, economic output is tracked by GDP. So we'll click to show you 3 trend lines related to each of these variables just to illustrate a point. Claims for unemployment insurance are below the levels they were at prior to the pandemic. The unemployment rate is a hair above what it was before the pandemic. And in terms of economic output, we're well past where we were prior to the pandemic, and that's measured in trillions of dollars. GDP was at 21.5 prior to the pandemic, and aiming to be ahead of $24 trillion as soon as we have the next quarter's readings in. If you want to talk trend lines, though, to get a real appreciation of how healthy we think the economy is, we're looking at the same 3 variables on this slide, but over the past 10 years. And if we just focus on GDP, you'll note that currently output here, again, measured by this blue line, well outpacing the long-term trend line over the past 10 years. And we think that actually is going to be something that we can relate to the inflation story a little later. I mean, the economy is running a bit hot right now. GDP is one indicator of that. We're seeing a slope that's much steeper than the slope that we were seeing prior to the pandemic. And expectations for GDP, by the way, are that growth is going to level off in the coming quarters. But if we're just focusing on looking at the health of the economy and looking at output, trend looks great. One more chart here before we pivot to the next segment here of our presentation. We came across this chart as we were preparing for today, and I personally fell in love with it. I think it tells a really clear, concise story about how the labor market has recovered. We were measuring 152 million folks being employed as of February 2020. Of course, we lost some 25% of those jobs almost overnight. And then you can see the recovery in stair-step fashion over the past couple of years.
I mean, that was really, I can so vividly remember. No, I'm just saying, I can so vividly remember the webinars we were doing back in early to mid 2020 and just marveling at the magnitude of these numbers. Which I'd never seen in my lifetime, and that's getting to be a long time at this point.
And I mean, the magnitude is still impressive. Things have slowed down, but the economy is still adding 500,000 jobs a month throughout the first quarter of this year. And we've regained 93% of the jobs that were lost, 2 years ago. So just really encouraging stuff. We know there's a lot of scary news out there. and as per usual, working to just even the playing field, broaden the perspective, and share some of what's encouraging and what's helping us feel a bit optimistic going forward. So on to the next segment. And of course, inflation has been the news of the day, or the topic du jour, for what feels like forever. It's been less than a year since the inflation reading popped up above 5% last May. And it sparked fears that we might be finding ourselves in a situation not unlike the 70s, where inflation rates exceeded 14%. We're going to talk a bit more about the role the Fed played in bringing those rates down later on in our discussion today, and that's revisiting a topic we've touched on in previous presentations. On this slide, we wanted to highlight just two key differences with respect to today's period relative to the 70s, and then maybe talk about a third difference as well. So employers were dealing with a workforce that was much more heavily unionized in the 70s. And so those workers were able to negotiate higher wages and had more bargaining power at that point than the labor force does now. You've heard perhaps in the topic on the subject of inflation, this notion of what could be a wage spiral. So with higher wages, employers have to then pass on the cost of paying those higher wages to consumers. That leads to higher prices, which ultimately leads the consumers, who are also the workers, to ask for higher wages, leading to prices continuing to increase. So this point that we're making here about the workforce being less unionized now is a point against the potentiality of a wage spiral driving upward inflation onward and onward as things continue. And then, of course, the other thing that we'll talk about more as we go through the presentation today is the role of the Fed. Obviously, the Fed sought to break the back of inflation going into the 80s, and that was its chief focus for several years. And we know the Fed has made a lot of comments about its stance on how it's going to attack inflation and how that might be different this time around, letting things go a little bit before raising rates. And yet here we are, not even a year into this current inflationary period, and the Fed already taking action. As a contrast, in the 70s, the Fed let things roll for years on end before taking action, ultimately paying the price by having to take drastic measures in the 80s. And we're just not thinking that things are going to be the same in that department this time around. And so here's what the inflation rates have looked like over the past couple of years. You can see here in early 2020, rates were low, popping up last spring. And then, let's go back a slide, excuse me. And then over the past several months, things have continued to be on a kind of scary trajectory. We'll note a couple of things for people who have been criticizing the Fed and saying they've been slow. Again, the Fed has taken action relatively quickly if you compare it to historical precedent. And it's been less than a year since things popped up above that 5% marker. And note that for the several months after that, the rate actually was coming down for a bit. So it didn't actually look like action might need to be taken at that time. And rates were coming up towards the end of the year. And then even afterwards, things were starting to flatten out. You can see the curve here. And then, of course, Russia invaded Ukraine. And we bring that up in this particular part of the discussion because as it relates to the economic elements that Dave was alluding to earlier, I'm showing you this chart because it breaks down the components that are factoring into the inflation rate as measured by the Consumer Price Index, or CPI. A year ago, energy, oil prices wasn't even a significant factor. The headlines at that time were used cars and trucks and all the supply chain issues that were factoring into historically high prices for those products. And as we moved into the summer, oil playing a bigger role and the components kind of holding steady. Here's the spike as of February in oil prices, which aligns directly with the timing of the invasion. And so Russia being a major producer of oil, having embargoes, sanctions put against the Russian government based on their actions, that's thrown oil markets into a bit of a tizzy. And so you can see energy
That's such a
taking up
mild way
half.
of putting it. A bit of a tizzy. That's pretty dramatic.
It's incredibly dramatic. I mean, so you're seeing, Dave, as you're pointing out, half of what's driving the inflation number right now, fully accounted for by changes in energy prices. And so this is not to predict what's going to happen going forward, although we would say that as things settle in the Ukraine, and as things settle in oil markets, we should see things calm down on the inflation side. We'll see when that happens, and there's a lot to be worked out before we see things settling down.
And Yusuf,
and of course,
quick question. If you can jump back 2 slides and just confirm, we had a question on the light blue line, the US PCE. What does PCE stand for in that one?
So PCE is the measure of inflation the Fed uses for its inflation opinions. So it certainly takes count of CPI, which is the purple line, the orange line being core CPI, which removes energy and food prices, which are 2 of the most volatile components of the inflation number. And then PCE is just another measure of inflation that looks at the different factors, from a different perspective, and is the one the Fed uses in its decision-making process when choosing to adjust rates.
And Yusuf, correct me if I'm wrong, I think it stands for personal consumption expenditures.
Perfect. Yep. Thank you. Exactly. And I failed to mention, by the way, here's the federal funds rate on this chart, and you can see it ticking upward as of late. The most recent Fed meeting, of course, they raised rates by a 1/4 point. And again, we were just highlighting that in less than a year, the Fed, of course, observed what was happening in the economy and took action, and is slated to take more action throughout the year, as we'll talk about moving forward. A slide here really just showing the effects that consumers are feeling in their pockets in terms of one of the economic ramifications of the war in Ukraine. With oil markets being thrown out of whack, gas prices have shot up. Since leveling off, by the way, you're seeing this chart here going through March of 2022. The April numbers are starting to peter out a little bit, and we've seen that with oil prices kind of consistently hovering around $100 a barrel over the past several weeks. So a question we've been getting from a number of clients is what we're doing to position the portfolio well in the face of the threat of inflation. Another busy slide, and yet we chose this illustration because we think it makes a powerful point. You're seeing on the left-hand side inflation rates around the world, charted by these various line graphs, and the 8 countries selected, the US and then 7 more. We then listed on the right-hand side each of the countries, their respective current inflation rates, and then in parentheses, the proportion of the portfolio that we employ for our clients. So the US making up 46%, these other 7 countries make up 36% of our equity portfolio. So a not insignificant slice. And when we look at the inflation rates of those countries around the world, aside from Germany and maybe the UK, all significantly lower than that of the US. And it's important for us to note a couple of things here. Number one, we of course we employ a globally diversified portfolio. Number two, it's a portfolio that's unhedged to different currencies, meaning our clients' investments in foreign countries around the world are denominated in the respective country's currency. And so having that unhedged portfolio with respect to currency fluctuations and exchange rate risk, we're able to hedge the portfolio against inflation in the event that the inflation rates of countries around the world are different. So that's one of the protections that's in place. Of course, another one of the protections is the amount of the portfolio that we stack in favor of equities, in favor of stocks, which have, of course, a higher growth potential. More growth in the portfolio preserves and protects its purchasing power over the years as time goes on. So,
and there's actually been research. There's been research over the decades that shows that stocks in general can do what's called impounding inflation into their returns, so that they can adapt. You know, companies often have pricing power so that they can, you know, inflation just gets passed along in higher prices, but it doesn't affect their profits in real terms. And the other thing, just to your first point, interest rates and inflation rates, relative interest rates and inflation rates between countries affects the exchange rate. And so if interest rates end up and inflation rates end up higher in the US than elsewhere, in general, that means that the value of the dollar will fall. But when the value of the dollar falls, it means that all of the returns you earn overseas actually get bigger in dollar terms. So you actually get a boost when the dollar is falling with respect to half your portfolio, more than half your portfolio.
So just underlining, why we take a global approach to building a portfolio is you want to mitigate risk on whatever front you possibly can at all times. 2 down, 3 to go. And so as we move into our next segment, we'll be focusing on the war in Ukraine. Just a brief.
Sorry to stop your flow. We just got a question back on inflation I wanted to pull in before we went on. Is the USA the highest inflation because its economy is the most overheated? Is it normally higher than other countries?
Can't speak to the historical precedent, and Dave, maybe I can lean on you in that department. But in terms of currently, no economy has rebounded more quickly than the U.S. From the crash at the start of the pandemic, and so you're seeing that reflected in the inflation rate relative to that of other countries around the world. Dave, any comment on the historical precedent related to the United States and inflation?
Over the longer term, over the last actually decade and a half or more, the U.S. has tended to have lower inflation. And part of the reason for that is because the U.S. dollar is the reserve currency of the world. And as a consequence, the dollar has, through all of the crises from the dot-com crisis to the real estate bubble to COVID, it's tended to boost the value of the dollar. And boosting the value of the dollar, first of all, it did cause a lot of imports to be sucked in, but those imports come in at really low prices in dollar terms. And that's also tended to depress the value of the dollar. And interest rates and inflation rates are related. And for the last 20 years, when in doubt, people wanted to buy treasuries. And that kept treasury rates, even for the 10-year treasury, often at or below 1%.
Thank you for that. And now moving into some comments about Russia's invasion of the Ukraine. So the invasion began on February 24th. And circling back to something that, Dave, you mentioned at the top of this discussion, the human element is, of course, the most critical factor. And so since the invasion, there have been thousands of casualties, millions displaced. It's a tragedy. There's really no other word for it. And our thoughts and prayers are with the folks in Ukraine. And we're hoping for peace and a resolution as soon as possible. In response to the actions taken by the Russians, sanctions were imposed by the U.S., dozens of nations around the world as well. And the response has been intense. The world has been pretty clear on its stance in terms of how it feels about the actions that Russia has taken. And it's been tough for the Russians. The military failed to capture Kiev. And now efforts have shifted to the east. The goal for the Russians is to maintain, or they desire, Ukrainian neutrality, and are threatened by Ukraine's goals of wanting to be more independent and a member of NATO and things of that nature. Russia wants control, and they've been taking actions to try to gain more and more control. And we'll see how this plays out. But again, our hope is that we find peace soon. In terms of the economic ramifications, much of the focus has been on the oil markets and how things are moving around and changing. Headlines recently have focused on an embargo by the European Union, whereby they would stop importing Russian oil. Some of the countries in the European Union that are the top purchasers of Russian oil, Germany, Poland, they would be most drastically affected by this embargo and would have to find other sources for oil and natural gas as well. As a consequence of what could be coming down the pike, India and China, interestingly, have been ramping up their purchases of Russian oil. And if we look to this visual here and we rank countries around the world by their consumption of oil in general, China and India are two of the largest consumers of oil. So interestingly, Russia may have ready-made replacements ready to go in terms of where they can sell their oil. We're not going to try to predict what's going to happen and how it's going to affect, individual nations or markets or the economy writ large. We do know that markets find equilibrium, and we do know that the oil markets will settle at some point, and that when they settle, when prices stabilize, that will be good news for markets and economies around the world, because then businesses can begin planning their path forward with that part of their calculation stabilized. But it'll be interesting to see how between Russia, China, India, three of the largest landmass countries in the world, the interplay between those three nations with specific focus on oil markets. And so as we kind of sum up ramifications, and Dave, I'll pause here at the end of this slide for further comments from you if there's anything you'd like to add here. The ramifications we summed up is kind of in three aspects. Number one, we've talked about it, higher prices for commodities. We focused much of our comments on oil and gas, but with oil being a huge factor of production, it's going to affect things like food prices and other items, around the world. In addition, to the extent the conflict continues, there may be supply chain disruptions. And so neighboring economies, countries may be affected by the actual physical conflict as the war goes on. And then last but not least, war breeds uncertainty, war breeds fear. And so may there be reduced confidence with respect to businesses and investors in the face of ongoing uncertainty as the war continues. Those are the three kind of significant areas that we've identified, and those are the things that we'll continue to watch as events play out.
And the only thing I'll add is that we didn't choose to go down this rabbit trail, but I have seen significant analyses of how European consumers of Russian gas could, at least over the next couple of years, replace that. Some of it through vastly ramped up shipments of liquefied natural gas from the U.S. We have not traditionally sent that to Europe because they were traditionally running pipelines to Russia, but we have the ability to ramp that up, and there are in fact shipments already on the way. And so between sourcing from other places, including the U.S., I've seen plans that really look like, and Germany is in the lead because Germany was the biggest consumer of Russian gas and oil, but especially Russian gas, that they have the ability to redirect without too many disruptions, at least over the next couple of years. And of course, capacity will continue to build over that period of time. So as Yusuf said, uncertainty is one of the biggest factors that drives markets. And so as the uncertainty diminishes, we think we'll see the markets recover as well.
Absolutely. So moving on to a few comments about the Fed and how they're manipulating interest rates to battle inflation. First, and we've shown you this chart before, a bit of history, the past 40 years, inflation depicted by the purple line and the federal funds rate depicted by the orange line. And just now starting to tick upward as the Fed works to combat what's been the largest increase in the inflation rate in 40 years. We thought it interesting to note just over the past 40 years that you can see the trend line. The inflation rate has been coming down, and if you want to see another trend line, we identified what 2% would look like on the chart. And we'll note, the Fed's mandate is to keep inflation hovering around 2%. It's been doing that more or less for the past 30, 40 years. It'll be interesting to see how things how they wrangle the inflation rate over the coming months and years. But this reminds me of a point I wanted to make earlier. I mentioned there were kind of three components to the inflation story. The third component being that what we're seeing here in terms of this jump, this spike in the rate, makes a lot of sense when you think about how dramatic the downfall was at the start of the pandemic with respect to economic output, and then how dramatic the recovery has been since then. And so seeing a dramatic spike in inflation as a response, as we're moving through a recovery that's been happening at a speed that folks might have called crazy at the onset of the pandemic, it fits with the rest of the story, seeing a rate that's this high for now. And we'll talk about what some of the expectations for the inflation rate going forward are within the context of current events.
Can you go back to before you?
Absolutely.
Yeah, just the one thing I wanted to point out was that the shaded areas, the gray areas, those represent recessions. Yep. And I think it's worth noting that before each one of these recessions, you see the Fed funds rate rising. And the Fed has historically been kind of a blunt instrument. They often overshoot the mark when they're worried about inflation and send the economy into a recession. That's the reason. This history you're seeing right here is the reason that Chairman Powell and the rest of the Fed governors are being so cautious and have been so cautious about raising rates, because they look at this same history and they say, historically, every time we get worried about inflation, we send the economy into a recession. And we would like to moderate inflation without doing that this time.
Fingers crossed. And so, you're just seeing a depiction here of the last time the Fed raised rates. You can see the stair step and how gradual the increases were. Been a lot of noise being made recently about how the rate of increase in the interest rates may be a bit more aggressive this time around. The expectation is for the rate to be increased by 0.5 point at the Fed's next meeting. We'll talk about that on a future slide here in just a moment. But interest rates are coming up. And yet, even within the context of all of the events around the world, the Fed's expectations are that the inflation rate will be at its target of 2%, at or near its target by the end of 2024. You can see the trajectory here. We like this slide because it shows how the Fed's projections have been changing over the past 6 months. The light blue line was published in September, with the expectation being that inflation would be at 2%. And that's by the end of 2022. So you're seeing the end of 2022 here, end of 23, and end of 24. So the initial projection was by the end of this year, inflation would be at 2. That ticked up when they revised their projections to about 2.5. Now projecting about 4.3%. But notice, still over the intervening years, pretty significant decline and tracking towards that 2% target over the next year or two. And so we'll see whether or not these projections pan out. But it's encouraging, we think, that the Fed is still publishing these kinds of projections even amidst the news of the day. And then just to give you at home a sense of the cadence of how interest rates may rise over the remainder of the year, it's been said that we can expect maybe the Fed to raise rates at every meeting. So we thought you might like to know when those meetings would be. The first coming up in the first week of May, the expectation being a 5% rate hike. And then we'll see what happens in the subsequent months. 0.5%, excuse me. 0.5%, yes, 0.5%. To make people nervous at home. 0.5% rate hike in May, and then we'll see what happens throughout the rest of the summer and going into the fall. And interest rates are, of course, not the only tool the Fed has available to it. You'll hear on the news the Fed thinking about winding down its balance sheet. And so how does it do that? So the Fed manages the money supply by buying and selling bonds. If you hear the word tapering, it means the Fed is buying fewer bonds. And the Fed has been tapering for some months now. It can also cease purchases, so not invest capital in bonds, not reinvest capital in bonds. then, of course, it can actively sell bonds, and by doing so, take money out of the money supply, try to slow the pace of things moving around in the economy, and bring activity down, such that it would help prices come down and inflation be calmed down as well. Those are additional measures the Fed can take. We'll see how it chooses to use those tools as the months and the rest of the year plays out. But we just wanted to have some explicit definitions in here to make plain what the Fed can be doing as it works to combat inflation through the rest of the year and onward.
These all fall under the heading of what they call open market operations, right, as opposed to the Fed funds rate, which the Fed sets directly, and that's the rate at which banks lend excess reserves to each other overnight. And so the Fed directly controls that particular interest rate, and that's the one that they're going to be talking about at every single one of their meetings this year. But as Yusuf said, the open market operations, some of this involves what they called quantitative easing, where they were actively buying bonds, trying to keep rates lower in the longer term part of the bond market. But I think you'll see all of this tapering, ceasing. I don't know how quickly we'll see active selling, because I just think they're going to be more cautious than that. But as Yusuf said, it's in their toolkit.
So we'll close this segment with a few reasons for optimism. Think about inflation. Inflation is a measure of how rapidly prices are rising. For anyone who's taken an economics class, you'll recall that supply and demand, those two curves, the X at their intersection, that's the price. And so we're highlighting supply and demand here. On the supply end, as we talked about at the top of the presentation today, COVID cases have declined worldwide since Omicron, and the severity of COVID cases has continued to decrease. That should help on the supply chain side. The fewer interruptions we have as related to COVID, the better producers will be able to perform and provide goods and services on the supply side. On the demand side, you may have started hearing this phrase being bandied about, which is the cure for higher prices is higher prices, meaning as inflation continues, or if it continues and prices continue to rise, at some point, higher relative prices become unpalatable for consumers. They stop spending money. That, in turn, helps prices stop increasing. And so between those two factors, we're hoping to find equilibrium and a reduction in the increase of the inflation rate going forward. And then, of course, the Fed's role is to play kind of market maker and make sure that it's helping to drive equilibrium between those supply and demand factors by way of using interest rates and open market operations, as we were just talking about. Here we are in our final segment. And so you may be wondering, given everything that we've been talking about, how's the portfolio doing? How are you doing, at least financially? So let's talk about performance. So these numbers are year to date through yesterday's close. And so you can see Yeski Bowie's equity portfolio represented by the purple line. So the stocks in our clients' portfolios throughout the year, down about 3%, again, through yesterday. When we measure that performance against our benchmark, as indicated by the blue line, the All Country World Index, global index of stocks around the world, those stocks are down 7% year to date. So do we ever like to see negative returns? No. Outperforming the benchmark by 4% over a short term, it's encouraging. And we certainly think that we have a sense of why that's the case. We have the S&P 500 in here because everyone always asks. As we've noted, it's not the most appropriate benchmark. The S&P 500 focuses on U.S. large companies, whereas our portfolio is a global portfolio, U.S. and non-U.S., large companies and small. And yet, folks like to know, and so we've got the S&P in here as well. We're ahead of that by 3 percentage points. The reason behind the outperformance can be summed up in one word: value. Folks who've known us for a while or who have heard us talk about investments know that we tilt our portfolio towards value stocks or companies who've had their prices pushed down as of late and are therefore priced for higher returns or better performance than their more expensive counterparts going forward. What you're seeing is a ranking of the performance of each of the components of our stock portfolio, of our equity portfolio, throughout the beginning of the year. And you can see the best performers have been, be they international or domestic stocks, be they large or small, value. Value has been winning relative to every other component of the portfolio, not just through the beginning of the year, but for some time now. But as we're looking at just, focusing on the first quarter plus, I should say, value has taken the day. We're gratified by it. We're not particularly surprised given economic conditions. You would expect value to be performing better than the rest of the portfolio as of now. And that outperformance has been buoying the portfolio in these uncertain times. And so unsurprising, but certainly gratified to see the portfolio doing what it's supposed to be doing. And you have a bit of a look under the hood as to some of the components that have been explaining our outperformance relative to our benchmarks so far this year.
And I did see a question about, are the other categories growth? The answer is no. I mean, except for the S&P 500, which is tilted towards growth, partly because it was eaten up in recent years by a handful of mega tech stocks. And international large is also a blend of value and growth. So there is some growth here. There is some broad market that includes growth stocks, but we very consciously want to be tilting away from that. We want to have a little bit of everything, but if we're going to have more of anything, it's going to be the value stocks, whether large or small.
Absolutely.
And one more quick question came in. Is there any reason why global real estate hasn't been its traditional port in a storm?
So it actually has for much of the storm. If we zoom out, and we have charts that we can share as a follow-up, if we zoom out and look at the past couple of years, especially in 2021, real estate had a tremendous year. I don't have the percentages memorized at this point, but it was one of the top performers in 2021. We haven't seen that thus far this year, kind of giving back some of the gains that real estate had been earning over the past year, 18 months. But it has served that role, just not quite seeing that year to date. Anything else coming through with questions, Lauren? All righty. And so we'll close here. Just as a reminder, we've described our portfolio as an all-weather portfolio designed for all seasons and one that's certainly well-positioned for this particular economic climate. We talked about the benefits of being globally diversified and unhedged with respect to currencies of the various countries represented around the world. We've talked about the value of being tilted towards value, pun partially intended. Value stocks are well suited for good performance in a rising interest rate environment. We've commented on that previously. And then just having a higher allocation to stocks. Certainly more than half of virtually all of our clients' portfolios are tilted in favor of stocks relative to bonds. Higher growth potential ensures against the purchasing power risk that inflation poses to the portfolio. And so just highlighting a few of the traits that we think make the portfolio well suited for the current environment. And again, gratified to see good performance, especially relative to our benchmarks thus far this year.
I also saw a question about, should we cut back on our spending target? And the answer is no. The spending target, we apply the safe spending rules once a year based on December 31 values. And if the capital preservation rule were to be triggered, we would be changing your spending target. We'd be moving it down by 10%. But we're not going to worry about that until next December 31 when we rerun the spending rules. And that's one of the things that we've always liked about our safe spending system is that because it has some dynamism, because it does include the possibility of targets going up and down, it allows you to be on a higher spending trajectory, but it has stability. The rules only get applied once a year. And for the rest of that year, you know what your spending target is, and you don't have to worry about what's going on in the markets or in the economy.
Yeah, and we give things room to breathe. I mean, we were having the same kinds of conversations in the spring of 2020. I don't know that anybody would have expected that we would have ended the year net positive, and yet we did. So no capital preservation rules were really required in response to the most recent downturn. But yeah, to your point, Dave, we'll see where things lie at the end of the year, and lots to see unfold between now and then.
We have a couple other questions that have come in. One that I think plays along really well with that safe spending discussion is, what is your thinking about bonds in this known interest rates are going to be rising kind of environment we're in?
Dave, do you want you or I to jump in on that one first?
Yusuf, I'm going to let you jump in first, but I will tell you, I will preface it by saying that Yusuf and I we spend more time obsessing about bonds than you can possibly imagine. Sometimes it's like a daily conversation between us. We're having conversations with the managers of the bond portfolios we use. We're revisiting and reanalyzing all the time, but I'll let you take it from there.
Yeah, and it's been a rough go. Bonds have had a rough go of it over the past year, and especially over the past 6 months. Again, we've been asking a lot of questions. We've been looking at things from as many angles as possible. We continue to like the particular bond portfolio that we're using in most of our clients' accounts, DFA's global bond portfolio. It's going to remain a part of the portfolio, and we're looking at potentially other options. We want to make sure that the bond portfolio is doing what it should be doing. And so we're looking at perhaps adding other funds to the mix. We're continuing with our analysis in there to see what's going to be the best route to take, but we'll certainly have more to say about bonds going forward. For now, we think what we've been using, the global bond fund from DFA and most of our clients' accounts, it's been doing its job, taking a hit as of late, but holding steady, especially relative to other bond funds that we've been analyzing. Some, certainly those with longer maturities, that have taken an even more significant hit as of late. And so we're gratified to see that the bond fund we're employing has been well managed in the face of some unprecedented circumstances over the past couple of years, and encouraged by what we've been hearing about how it's positioned going forward. Dave, what would you add?
I wouldn't add much of anything. I mean, I would say that, yes, as you noted, our bond holdings have gone down a bit in this rising interest rate and rising inflation environment. But, our thought has never been that bonds don't ever go down. It's just that we want bonds that won't go down by very much. And that has proven to be the case. And to the degree that they have gone down, this is where Yusuf and I have had some conversations with the actual managers of the bond portfolio, and they let us look under the hood in great detail. And we came away believing that although it took a little bit of a hit, those bonds in that portfolio are currently priced for higher returns going forward. So we think we're going to expand the bond funds that we use for certain circumstances, but we continue to like that one.
Is there another one, Lauren?
One more question here is, what worst case situation could change our calm approach? The war, interest rates, something else?
I don't know, Dave. I don't know that any worst case scenario would change our approach in terms of taking things in a measured way and being calm. Would you disagree with that?
We don't believe that. We believe in the resilience of humanity, and although bad stuff is happening in the world every day, human beings tend to adapt. And it's why, even though you see a lot of squiggles when you look at a chart of economic growth or you look at a chart of the market over the long run, there are always squiggles because the market is always trying to figure out what the daily news means. But the trend is always upward, because whatever the daily news means, human beings will find a way to adapt to it. And so we continue to believe in that. But we do believe in having deep resilience, which is why, every one of your portfolios has 13,000 stocks in it, diversified globally, because we think we need that degree of deep resilience. But you would have to believe that the global economy is going to permanently decline into some kind of dystopian Mad Max kind of world And in which case, it doesn't really matter what you own, unless you, I mean,
Right.
guns and bullets, I guess, is what you'd want to own in that world. But we're not really in that business.
No, we are not.
So a couple more coming in here, Yusuf, maybe back to that rising interest rate environment, both of them related. Why bonds instead of cash in the environment that we're in?
Well, and on a forward-going basis, we would expect bonds to do better than cash. Yes, bonds have taken a hit as of late. Cash isn't doing anything but losing value because, as we pointed out, the inflation rate over the past 12 months has been 8.5%. The bonds aren't down 8.5%, and so that's not to be trite, but bonds are technically still doing better than cash right now.
And one more, also related, historically, have equities ever outpaced inflation when inflation is relatively high? For example, can a portfolio increase in real value with inflation above, say, 5%?
Yeah, and Dave was making that point earlier that stocks tend to impound inflation, so their returns factor that in. You've given me an idea for a chart I'd like to run now. So perhaps one of a future digest article might focus on that.
Great. Well, those are the questions I have now. I'm still watching. If anyone has any other questions, feel free to type them into the chat or the question and answer section. Give it a minute. And I also Yusuf, oh, go ahead, Dave.
Well, I was just going to say, and we love the questions because, even if we don't have an illustration of how we would answer that question, as Yusuf said, you just trigger future Live Big Way Digest articles and future webinars.
Not seeing anything come in. So Yusuf, if you want me to dive into the final poll, I'm happy to do that.
Please, yes, that would be great.
All right, I did just get a question about how's the baby, any fun pictures? So yes, I will, she's great. She's crawling now, 7.5 months old. The days of rest and relaxation and setting her down for more than 10 seconds are gone, but she's great. And I'll send you some pictures.
So Lauren's going to launch a poll where we're just going to ask how you're feeling. We did at the top of the hour. We'd love to know how you're feeling now. We're not going to share these responses. Feel free to answer honestly, but just checking in and seeing how today's discussion may have helped your overall outlook. Encouraging responses. We won't breach confidentiality, but encouraging responses, and grateful for your feedback. Thank you. Well, this has been fun. Thank you all for being here. Dave, any closing comments?
Only to say, we really value the trust you place in us. And so, we really like the opportunity to talk to you as a group, as we're doing now, to talk to you one-on-one. The faith you've placed in us is something we treat as a sacred trust. And you just have to know we're always there. As you've heard us say many times before, we want to be your first call. Whatever the topic, whatever's going on, pick up the phone or shoot us an email and we'll walk it around the block with you. So thank you for joining us. This is being recorded, so it will be available to you and any of your friends or colleagues you might want to share it with. And we've just enjoyed being here with you.